Bank of England today has raised base rate by half a percentage point from 4.5% to 5%. That's another bumper rise and comes despite major concerns on the impact on mortgage borrowers. Why is it doing this? It's doing it to combat inflation. Now, inflation is meant to be around about the target level of 2%. It's spiked over the last year and a bit to more than 5 times that, into double-digit territory. It's fallen out of that territory since then, but the bank is concerned that inflation is not falling fast enough and that there are still many inflationary pressures. It can't do anything about the inflation that we've seen already. That's in the past. What it's trying to do is crack down on inflation in the future and stop it becoming embedded in the economy and inflation remaining high for months or even years to come. We've seen mortgage rates spike over the past month in something that's very reminiscent of the mini panic that followed last year's mini budget. That was very badly received due to a raft of ill-funded tax cuts that caused problems in the UK government bond market, in the pension market, and then led to the expectation that interest rates were going to have to rise much more than expected. After that, mortgage rates came down and the market calmed. But all of a sudden, we've seen another panic. This time round, it's being driven by inflation and the expectation that the Bank of England is going to have to keep raising rates in order to tackle stubborn inflation. About a month ago, the expectation was that interest rates would probably settle around 4.5% and not go any higher. Now the expectation is that they might go up to 6%. In response to that, mortgage lenders have been pulling deals and pricing them upwards. And due to the sort of vicious circle that's going on here, we've seen a sudden and rapid rise in mortgage rates. Now, hopefully, things will start to calm down and rates will start to decline. But people should remember that even if they do fall slightly, they're not likely to come back down to the super low levels we've seen in recent years. The spike in mortgage rates has been substantial over the past month, and it's seen the average 2-year fixed rate mortgage rise above 6%. If you take that in the context of people who might have fixed 2 years ago and are now coming to the end of their deal, they could have fixed at an average rate of around 2.2%. On a £200,000 mortgage over 25 years, for someone with a 25% deposit, that means they're looking at more than £400 a month extra. 5-year fixed rates have also risen. They're not quite as high as 2-year fixed rates at the moment, and they were a little bit higher 5 years ago. So that gap is narrower. Someone with the same mortgage, in the same scenario, coming to the end of a 5-year fixed rate, needing to remortgage now, would be looking at potentially paying about an extra £350 a month. Now, this is obviously a major problem for people because they've seen all their other bills rise as well. Their energy bills, their food bills, the general cost of living. So what people need to do, if they are coming up to the end of a mortgage fix, is work out how much they are likely to pay and find the best deal that they possibly can. To work out what you might end up paying, go to thisismoney.co.uk/mortgage-finder, where you can use our best mortgage rates calculator to show the deals that you could potentially apply for based on your home's value and your mortgage size and how much your monthly payments would be. Nobody knows what's going to happen to mortgage rates next. We're in such a volatile situation that it's possible that this might be the moment of peak panic and that they will actually decline quite a bit, as they did after the mini-budget panic. Or it's possible that the Bank of England will have to keep raising interest rates. That expectation will become embedded into the mortgage market and they're going to stay roughly as high as they are now. What we do know is that the last month has been absolute mayhem in the mortgage market, so this is possibly the worst possible time to be looking for one. However, it all depends in the sort of next couple of months and the end of the year what happens with inflation. If inflation starts to fall away faster than thought, if that core inflation starts to come down, if we start to see less inflationary pressure, then we could see a change in interest rate expectations, some calm come back into the mortgage market, things start to settle down and rates start to come down again. If you need a new mortgage now because your fixed rate is coming to an end, then you need to plan ahead. Ideally, if your mortgage is up in the next few months, you've already been thinking about this. If you haven't, speak to a broker, find the best rates that you could apply for, have a conversation around whether it would be best for you to fix for 2 years, for 5 years, or for a different period of time, and try to plan ahead with your finances. Once you understand what the rate might be, you can work out how much more you'll be paying each month. If you have a fixed rate that's coming up for renewal further on, then what you can do is you can lock into a fixed rate now, and if you add the fee to the mortgage, in most cases you're not obliged to take the mortgage out, and if rates come down before then, you could swap to a cheaper deal. If it's in the next year or so, then you can't lock into a fixed rate already in most cases, but you can start to plan ahead and get your finances ready, and know that even if the current mortgage panic passes and rates come down slightly, they're likely to be substantially higher than the ones that you took out 2 or 5 years ago. If you're buying a home, then hopefully, if you've had an offer accepted, again, you've got your mortgage sorted. If you're further back than that, then maybe you need to reconsider how much you can afford to borrow. Don't want to overstretch yourself and find that you go into financial difficulty later on. Finally, if you are struggling with your mortgage, then you need to speak to your lender. Don't put your head in the sand. You need to speak to your lender, explain that, see if there's anything that they could do to help you. Most banks and building societies will go out of their way to try and help their borrowers. And if you're having problems with debt, speak to an organisation like the Sisters Advice Bureau or one of the debt charities. And again, if you want to try and work out how much a new mortgage would cost you now, go to thisismoney.co.uk/mortgage-finder, where you'll be able to do the maths for yourself.